All right, back. Invest Info episode 14. And I've been talking about it. And today I'm going to show you guys how to get paid while you wait. Charlie Munger says we don't make our money by buying or selling, but we get our money by waiting. And I spoke about dividends and selling covered calls. Let me start first with a dividend. The company that we're looking at is Invesco Mortgage Capital, tickers IVR. I'm not suggesting you go out and buy anything. This is just for educational purposes. It's something that I currently have exposure to. Did my research on the company. I got the thesis, the moat, looked at the balance sheet, looked at the management team, and I'm invested. Now, they pay out a quarterly dividend prior to COVID of $2 annually. So that would be 50 cents per share. With the COVID situation, the stock plummeted and the dividend fell to 2 cents a share and got that payout. Now, this is the power of compounding. They paid out a dividend at 2 cents per share, and I'm not going to disclose how many shares I have, but, it was roughly 2 something, right? Now, they upped it to 5 cents. And this quarter's upcoming dividend on October 27th, I'll be getting paid $636 for my position in IVR. Now, look at this. This is $636. Look at the power of compounding. If it reverts to 12 cents, that'll be $1,500 with my current position in Invesco Mortgage Capital per quarter to wait. And if it goes back to 50 cents a share, pre-COVID prices, then you do the math. And you have the ability with Robinhood or your particular broker to reinvest that dividends into your position. In other words, I could take this 636, reinvest it into IVR, and on the next quarterly dividend, they'll pay me on top of that. So, and then so on and so on as the company revert back to its current dividend. Now, IVR preferred shares is already trading back at 40. Dividend is already back at 48 cents per share. So it's just a matter of waiting. And this is what we talk about when we say we touch the interest, not the principal. I don't plan to sell my principal position in Invesco. Either I'm going to add to it, or I'm going to allocate this particular dividend into another company that I understand and let that position grow as well. That's one way. Now, here's the thing, though, about dividends, that we do get taxed on our dividends. You have certain people that build their portfolio around dividend, but this is how the wealthy stay wealthy. They make money while they sleep. This company is working for me. They're going to pay me out a dividend every quarter. My job is just to wait and be smart with this dividend payout. This is guaranteed money. This isn't speculation. This is what we're going to do. This is a guaranteed dividend. And we see that from one quarter to the next, that it increases dividend from 2 cents to 5 cents. And you can see the more capital you have invested in the company, the greater the dividend. All right, that's one down. Now, I want to speak about something a bit more advanced. This is selling covered call, and it's a form of options trading. Now, do we recommend buying and selling options? Well, sell options, as Phil Town does, and Warren Buffett does sell options. He does cash secured puts, and Phil Town sells covered call. They don't buy options. I wouldn't recommend buying options as well. Again, unless you understand the company. Certain people, you look at major institutions, when they do options, these options are 5 years out. Robinhood have 2-year leap options, on certain scenarios in a crisis where a stock plummets and, it has no debt and you understand the business, then more than likely the stock will revert back to its previous price. So in that way, you could buy a call option, which I'm going to do a separate lesson on options. It's a lot of information to pack in one lesson, right? But we prefer to be net sellers of options, meaning you could either sell a call or you could sell a put. But we're going to deal with selling calls right now. What's a call? A call is you have the right to buy. I'm selling my right to my shares at a certain strike price. That strike price is $3.50. As you can see, the stock is not trading at $3.50. And this contract, as you can see here, $3.50 call. The current premium is 28 cents per share. So you have to remember, one call is 100 shares. So we have to do 28 times 100. We get 280, right? So, sorry, we get $28. 28 cents times 100, we get $28. So right now, each contract is worth $28. Now, when I originally sold this call, the stock was trading a bit higher, and each contract I sold it for was at 45 cents. So 45 times 100 is $45. So the initial contract, when I sold it, was $5,000, $5,700, 127 contracts. Times 45 is a little over $5,700. Now you can see that the stock went down, so the value of this premium went down. When you sell covered calls, as the stock goes down or stays stagnant, it depreciates. And when you're a seller, the depreciation works in your favor. When you're a buyer, theta doesn't work in your favor because there's less time to speculate what this stock is going to do in the future. So when we sell options, time works in our favor. When you buy options, time doesn't work in your favor. Options are a depreciating asset. So based on the price movement, I don't see this stock shooting up over $3.50 in the near future, right? Even though I'm holding this position long term, I don't see any major price movement happening. So I sold the call option. I'm going to show you how to do that. And as you can see, with time, from the time I sold it, it's depreciated a lot. So much so that I have a net return of $2,239 that I haven't used. I could always buy back my rights to my shares because that $5,700 I get, that premium, you could do whatever you want with it. You could take it out, you could invest it, or you can wait to buy back your rights. I'm going to still continue to wait. I'm going to be patient. But at any time, I could buy back those same contracts I sold for $5,700 for $3,556 currently, and I'll make a profit of $2,239. And the interesting thing about when you sell covered calls is you still get your right to the dividend of the stock. So even though I sold my rights to my shares, 127 contracts, 127 times 100 is 12,700 shares. Even though I sold my rights to that for a 2-year period, I still get the dividend. Now, look at this. If I'm still getting a dividend payout, the dividend itself could buy back the rights to this particular position. This is what the professionals do. They sell put strategies. You sell a put at a price you'd love to get into the position. And I sell a covered call at a price that I'm fine with leaving the position. So in other words, if worse comes to worse and this stock trades above $3.50, well, I would sell 12,700 shares of this position at $3.50. I'm fine with that. And no matter what, I still get the premium. So right now, in essence, I'm getting paid just to watch this particular stock. I want to see what it's going to do. And meanwhile, I'm waiting. I'm getting paid dividends and I'm getting paid in my sell call position. Now, I'm going to show you how to sell a call. You're going to go to trade. You're going to go to trade options and you have the position to either buy or sell. That's how trades work. You cannot buy. If there's a buyer, there has to be a seller. If there's a seller, there has to be a buyer. As you can see, when the premiums aren't pretty much valued anything for this month. But the further you go out in time, the premium starts to go up because there's room to speculate. Now, here's a January 2023 position. Let's use that, right? Because this is what I sold my original call for. Right now, the limit price, which is between the bid and the ask, is 45 cents. So 45 times 100 is $45. I sold 127 contracts. Roughly around this price right here. Again, you get that 5,700. If I was to sell this call right now, it would say, look, I'm giving you the right. I'm selling my rights to 127 or 12,700 shares of my position at $3.50 if this stock is trading above $3.50 before January 2023. Now, if I sell this position right now and the stock goes above that price, let's say it goes to $4, I cannot sell my position. I can't sell out my position for $4. I have to settle for the $3.50. That's how come we sell at. We do this at a price that we're comfortable with leaving the position. We value the company at a certain price. For example, right now the book value of this stock is $3.50. So if I get let go at $3.50, well, I got let go at the book. But if I get in at $2, then I make a profit regardless. So that's how come it's important to know what is the value of this company. What's the price that we're okay with leaving at? We want to get in at a price that is reasonable. That's at a margin of safety. And then we will sell a call at a position we're fine with leaving. So that's how we use options trading in a form of investing. Now, a lot of people use options to gamble and as a casino. That we don't recommend. That's not investing. Buying a depreciating asset is not investing, right? But we can use options traders because options were created to protect farmers from particular. Sorry about that. Options are created to protect farmers for their upcoming harvest. So it's a form of investing if done correctly. So that was explanation on how we sell covered calls. And you can look up YouTube videos of how to sell covered calls for more in-depth understanding of how to do it. But yeah, you sell at a price. You're fine with leaving. And we sell puts as well. Cash secured puts at a price that we think that this is a great margin of safety. That's another lesson for another time. And I'm going to sign out with that. I'll see you on the next one.